I use cash equivalents or gold as some of the more defensive sides of my portfolio rather than traditionally using long duration bonds as many would. And then I treat Bitcoin as a similar exposure that I would in an equity. So whatever percentage of equity I take out and put in Bitcoin instead. And I've been very satisfied with that approach.
Hey guys, welcome to Everyday Finance. Lyn Alden and Raoul Pal contends that global policymakers are purposefully devaluing the United States dollar in order to manage the United States debt of $36 trillion. This is paving the way for the rise of Bitcoin, which is currently maintaining a strong price of approximately $94,727. It is not a conspiracy, according to Pal. Rather, it is a simple calculation of the balance sheet. By pointing out that there is a historical correlation of 87% between the growth of the global money supply and the price of Bitcoin, he suggests that Bitcoin could experience a surge as liquidity increases as a result of potential rate cuts by the Federal Reserve in response to fears of a recession. For the purpose of protecting themselves against currency debasement, institutional investors are quietly reallocating their funds to Bitcoin. Pal predicts that the fourth quarter of 2025 may be a significant turning point. In the meantime, Lyn Alden provides a supplementary perspective by presenting Bitcoin not only as a hedge against inflation, but also as a fundamental technological leap that bridges a gap of 150 years between the speeds of transactions and settlements, thereby fixing money. Together, Pal and Alden argue that Bitcoin is not merely riding a macro wave. Rather, it is at the forefront of a revolution in the financial sector.
Well, yeah, the advantage that they both have, that they both share, is that they're global assets. So if you do get, capital repatriation, so capital coming out of the U.S., that can hurt U.S. stocks, but doesn't necessarily hurt gold or Bitcoin to the same degree. And the correlation with the Nasdaq, I've done a lot of research on this, and I think the shared correlation that they had is that they were both heavily correlated with liquidity for a number of years, especially in kind of the 2020 afterward environment. So prior to then, Bitcoin had less correlation with the Nasdaq or the S&P, and starting in 2020, that correlation went up because these big macro forces were just much larger pieces of many asset price swings. And a scenario where Bitcoin can decouple from the Nasdaq is one where you have like tariff-driven stagflation. If the margins of those Nasdaq companies themselves are what's challenged, and yet if liquidity is not heavily impaired, if the Fed goes back to gradually like not doing QT anymore and doing some QE and the deficits remain very large, you can get an environment where liquidity is not that bad, but margins are impacted, earnings aren't going up or aren't going up to the same degree. They're starting from a pretty expensive valuation level. And so you can have a couple years of poor stock price performance while more liquidity driven assets like gold or Bitcoin that don't have margins to worry about can still do okay. And so I think gold's had a really strong period. So I'm always, yeah, the value investor in me is always a little bit wary when something goes up that much, but I continue to hold as a slice of my portfolio instead of bonds. That's one of the things I've tried to focus on is that I use cash equivalents or gold as some of the more defensive sides of my portfolio rather than traditionally using long duration bonds as many would. And then I treat Bitcoin as a similar exposure that I would in an equity. So whatever percentage of equity I take out and put in Bitcoin instead. And I've been very satisfied with that approach. I think the way I would describe it is I'm not necessarily would have the view that bond yields would keep going up, but rather that probably at minimum they wouldn't go down as much as people think in an otherwise recession or economic problem scenario. So they don't necessarily provide the ballast that investors would want. And then that view can be exacerbated by hard to predict things like China purposely selling treasuries as one of the tools in their arsenal. So there's Boolean outcomes there for whether certain events happen that could make yields go up a lot more than we think. But the base case would just be that yields are not giving the offset. So they're not making, things more affordable for people. They're not lowering government interest expense. They're not helping with discounted cash flow calculations. So they don't, if bond yields go down, at least you can say, well, maybe equity valuations are allowed to be a little bit higher now. But if bond yields aren't going down, you don't have that offset. They impact mortgage rates indirectly, so you get less refinancing potential, which has an impact on the economy. And so I think that that's kind of the base scenario is choppy range bound in yields with potential for disruption should certain events occur, certain kind of intentional events, and depending on how the Fed responds to those attempts if they happen. Well, I think that the starting point is that if this does, and I think it will, if sustained, slow down global growth, then it can impact everyone, or not everyone, but a very high percentage of these countries, because even if their trade itself's not the issue, just less global economic activity can still impact them. And supply chains are complex. I mean, things can route through multiple countries and still end up impacting them. Certain pockets are more protected than others. One of the defense is simply that even if they're impacted just as much, if the starting valuations are less extreme, if they're starting at pretty reasonable or in some cases undervalued valuations, and there's not a lot of global capital stuffed into some of those markets, then there's less capital to flee and get scared and go elsewhere. So one of the issues in the U.S. is not necessarily that we're like uniquely impacted, even though we could be. It's that we're heavily impacted while valuations are high. So if Apple was trading more like a value stock rather than a growth stock, the impact might be less severe on it. Maybe that's an extreme example because they're heavily impacted either way. But if you take a typical equity that might not otherwise be directly caught up in the trade war, it was trading at 15 times earnings, it's a lot less risky than if it's trading at 45 times earnings with a similar growth profile. And I think that's one of the biggest protections you see in other countries, which is that in many cases their starting valuations were not as high. So when you have a bad day in the markets, it often ripples everywhere. So there's really no avoiding that per se. But when you look back over a 6-month period or 12-month period, always having somewhat of a mind toward valuations at least helps protect in some of the scenarios. Valuations are those things where they don't really matter until they matter. And these types of events are when they do start to matter.
Beyond the realm of macroeconomics, the fixed supply of 21 million bitcoins provides an unprecedented alternative to a system that is becoming increasingly unfair. Through this system, home ownership and wealth accumulation have been kept out of reach of the average person. On the other hand, Bitcoin levels the playing field by providing anyone with access to a form of sound money that is not susceptible to manipulation, in contrast to real estate and stocks, which favor the wealthy and connected. Bitcoin serves as both a shield to protect savings and a sword to fight back against the devaluation of fiat currencies by central banks and the ongoing inflation of asset prices, which is driving individuals out of the middle class. This is not merely another bubble in the investment market. Rather, it is a significant reversal of economic power from the wealthy to the common people. The next 10 years will not only be about the performance of Bitcoin's price, it will also be about reclaiming financial freedom from a system that has been stealthily robbing workers for generations.
I think in the initial period, so a few months, a lot of companies probably have a wait and see approach because if you don't even know what tariffs are going to be in 3 months, if you're a small business and you're saying, well, we're impacted, but maybe tomorrow the terms on those tariffs will change. We don't necessarily want to make giant business decisions for things that could change next week. So I think the initial impact is kind of just uncertainty. And uncertainty isn't it itself somewhat bearish because if you're uncertain, you just kind of take more conservative options for now. Just kind of keep the base case as going and try not you're not going to lean in generally. If many companies start to view these as sustained, if this is a new normal, yeah, I think over time you'll see elasticity, which is moving supply chains elsewhere, sometimes to the US, sometimes to other countries, which does come at expense, does come at often rising consumer prices or a slowing economy. Many of them are multi-year processes because if you want to, for example, massively increase U.S. steel production, that takes a lot of energy as well. The same shipbuilding, that's a very heavy industry. You need a lot of skilled labor as well. Robots can only get you so far, especially with something like building ships in the current era. And so that goes back to my prior point that the tariffs are impacting immediately, but some of the solutions or routing around those tariffs can take years or in some more extreme cases, decades to fully change or move things, but at least years is the starting point for how often it typically takes to move the equivalent of a multi-trillion dollar industrial base somewhere else. I think that will depend on the magnitude. Based on the current numbers, these tariffs are a multi-hundred billion dollar tax increase. And a lot of the proposals that they're looking at for tax cuts are not of the same scale. And it'll be, we'll see what ends up being able to get through Congress. But the starting point is that unless these tariffs come down, it's still a net tightening of the kind of the fiscal stimulus situation. And so I would say optically that makes sense for them to take that approach because on one hand, because this is still in the negotiation phase, everyone wants to appear as strong as possible. So China wants to appear strong, the US wants to appear strong. If you're the political party in power, you want to give a sense of calm. You want to say that you want to give the indication this is under control, this is well planned, and it very well might be based on later accords that could de-escalate this. But the current situation as of this recording is it's pretty hard to offset the sheer level of tariffs that have now come into play. I think to some degree. So uncertainty is itself bearish because if you're uncertain, you lean out of risk rather than into risk. So you delay things, you pull things, you make those types of decisions. Now, we've not seen, say, a massive increase in the 10-year yield or anything like that. So it's not like everything tightened that much, but you don't really have any sort of loosening to offset this so far. And so if you do get higher uncertainty, currently what is a big tax increase overall, that in itself is somewhat bearish. And there's the issue is mainly that there's not that many offsets. So it's not like this unsurvivable hit. It's just that compared to many other big hits of the past, there's not that many other parts of a portfolio or other parts of the economy that are able to kind of offset that. So base case is slower economic growth, potentially recession. I think it's too early to make that call unless again it's headline driven. So that could just be completely reversed next week. But basically, as long as we're in this current state, some degree of caution is warranted. And that's why my approach to markets is really to kind of try to sell some of the volatility, to look for things I'd want to buy at or around these levels, but I'm not jumping in right away because I want to see more policy certainty. Yeah, I do it in an unlevered way, and I do it kind of in the framework of a long-term investor, which is that I sell cash secured puts or in some cases covered calls, but in this market, it's a lot of cash secured puts, which is to say there are certain stocks I'd be happy to own, maybe not at these current price levels. And so I'm willing to sell a cash secured put at a price that might be 10, 20% lower, collect what is a pretty big premium in a volatile market, and then not really care about the outcome. If the stock goes down and gets put to me, I view it as kind of buying the dip in a stock that I like and that I've done analysis on. And I'm happy with those valuations and the risk with it. Or the market stays up or rips and I still collect the premium. And I'm like, well, so I didn't buy the dip on that company, but I got paid to take on the potential obligation to buy that. So yeah, when I do selling volatility, it's not those big like levered speculative types of selling vol where you're fine every day and then it's like the turkey at Thanksgiving where you just get wrecked all at once. I do it in an unlevered way for the purpose of reducing risk rather than maximizing profit. It depends on how long it's sustained. I mean, if a lot of this reverses in a month or two, then maybe it wouldn't be very heavily remembered. It's kind of like how many people remember the December 2018 market turmoil. It's not high on the list. I mean, macro people would know that reference, but it'd be less known among the general public. Whereas my base case is that this is a pretty big shift because that's why I've been writing about trade deficits for years. I think they are reaching a point where they have become a sustained accumulated issue, and I think this administration is pretty serious on trying to reverse them, and even subsequent administrations might be as well. And so I think that we've kind of stretched the rubber band about as far as it can go in terms of how much global capital stuffed into U.S. markets, how significant these structural trade deficits have gotten as well. And so I do think this will be kind of looked at as a somewhat transition point for some of that being restructured, rebalanced with turmoil along the way. So yeah, base case is probably a pretty memorable event for markets.
From a technical standpoint, the charts of Bitcoin are displaying extremely bullish signals. These signals include a double bottom breakout, a bullish pennant formation, and a completed falling wedge pattern, all of which project targets that are significantly higher than $100,000. There is a significant amount of room for further upside as indicated by momentum indicators, and liquidation heat maps also reveal a cluster of short positions near $100,000, which has the potential to set off a cascading short squeeze. According to the on-chain metrics, the technicals are supported by the fact that long-term holders are maintaining their strength, new buyers are accumulating, and more than 87% of the Bitcoin supply is profitable. This indicates that we are still in the middle stages of the bull cycle and are not close to reaching a peak. With macro tailwinds such as the anticipated reduction in interest rates by the Federal Reserve, rising inflows into exchange-traded funds, and Bitcoin's expanding role in traditional finance, everything is in place for a historic breakout. It would be more than just a price milestone if Bitcoin were to surpass $100,000. It would also be a symbol of Bitcoin's firmly established position as a fundamental component of the global financial system.